Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Normyle, U.S. Economist at Nasdaq, Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Steve Sosnick, Chief Strategist at Interactive Brokers, and Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. We're here to discuss broadening performance in the equity market and other areas as it starts to perform and we move into small cap and value dividend stocks and other areas within the market as well. Gentlemen, it's great to have you all with us. Putting the band back together. I feel like it's all of the like OGs on the show that have been here. And Chris, really that's what it is. That risk concentration is somewhat moving away, and we're seeing broadening across multiple areas of the market.
Yeah, I've titled this talk, Return to the New Normal. This is what we're trying to communicate with clients going into the fourth quarter, that obviously the last 18 months, 2 years, the Mag 7, concentrated large cap tech is where everybody's been. Well, ever since that sharp 10% sell-off in August, now we're seeing small cap and mid cap start to perform, value stocks, dividends. So when I say it's a return to normal, it's not just a super concentration in a small area. From an equity market standpoint, we're getting back to the way it used to be, where not everything was so concentrated.
Yeah, what's interesting, Steve, though, top 25 stocks traded at Interactive Brokers, it's still concentrated within some of those tech names, though. Some of it fundamentally based, though, in the news.
Well, that's sort of the paradox. Is it trading or is it investing? And I think we as a group, we've developed a trading culture, and that's very much here to stay. And quite frankly, that's a huge piece of our business. But to Chris's point, one of the things, a rotation seemed inevitable because you knew it just couldn't be seven or eight stocks forever. And so the question would it be money going out of the Mag 7 and Mag 7 adjacent stocks to go into the value plays, or would it just be new money coming in? I would say on balance, it's just been more new money allocated to those names without a lot of selling, which is why we've been able to perform the way we have. The one thing that gnaws at me is the NDX has not hit a new high for about 6 weeks, whereas SPX, just hit one yesterday. The last time I can recall that happening was November 21, January 2nd of 22, when Nasdaq topped out in November. S&P had a last gasp for the first trading day of 2022, and then we retrenched quite a bit. Right. I'm not calling for that. But that is sort of that's sort of the negative of rotation. When tech brings you to the dance, at some point they have to keep up their leadership at some level.
Couldn't that be a function of money going to other areas? I mean, financials have outperformed industrials and so forth, and of course there's no financial concentration in the Nasdaq 100, and they are in the S&P.
Yeah, that is true, but that does come into play because Nasdaq NDX explicitly excludes financials.
Right.
So that comes into it. Also some of it has to do with the fact that energy has become an AI play. Mm-hmm. So, you're getting certain defensive sectors really leading. I think it's in some ways misleading when people say, oh, defensive sectors are leading, but then it's utilities which are being run up for different reasons. Good reasons. I mean, Microsoft has just made a commitment to buy how many zillions of dollars of power from Constellation. But this is the type of rotation you have. And they all sort of, it's nice to see all the oars of the boat rowing in the same direction, and that remains the important part.
Chris, it's really interesting. Here we are, UNGA, Climate Week. I've never seen more people in this city. We know UN Week is always a nightmare here. I mean, the entire East Side shuts down, just for some context there. And the people that we have had on the show focusing on climate tech and regulation and so forth, the demand is because the tech companies are setting that demand out there. So this conversation around climate tech and renewable energy and providing these resources for that tech demand, that's why it's real, and they have to start executing on it, right? So it makes sense that these other areas of the market are coming into play.
That's part of it, but the other part of it is that the Fed is finally starting to signal that they're finally starting to catch up. Michael will go into that a little bit, I'm sure. But the 50 basis point cut was really a signaling that maybe the labor market is a little bit weaker than they thought. We got the readjustments. It was 30% less job growth that we saw this year based on the non-farm payroll adjustment. Something like 810,000 jobs or so came into play. But that being said, Powell's confident inflation is moving the right way. We get the PCE numbers this week. CPI, PPI, even though they don't look at them as much, do play into it. You can take the housing part out of it. the labor market's the key here, and with the 50 points basis cut, we're looking originally before that at least a full point cut for the year. It didn't matter where the 50 kind of fit into it. But the traders and talking heads have jumped ahead of it. Now maybe we're going to have 2 or 3 50 basis point cuts. And if you just look at the dot plot that we looked at last week, that's not the case. So back to Climate Week, it's a big topic of concern that was really focal before COVID hit. And everything that went along with the DEI and everything else was a big focal for a lot of investors at that point. And then reality hit, right? COVID hit, you're worried about losing your job, you're worried about passing away, whatever it might be. Now that we've finally come full circle, the yield curve is finally not inverted any longer, right? The return to normal, as Chris said, you're starting to see that play out. So again, this topic is arising. It is a concern for many investors, and there is significant money being thrown at it. So that's where if you're going to invest, follow where the money's being placed and spent, and you will be successful.
Which is so interesting, and we've asked this question as it relates to the market before, Chris. If we did not have, in November 2022, ChatGPT and Gen AI become part of the consumer vernacular, and that run-up associated with the market, would this conversation be different? Would Climate Week be different? It was because of these technologies becoming every day to us, and the demand for it. I mean, what if that didn't exist those past 2 years almost?
Yeah, and you're right, Jill, because again, to your point, Chris, I mean, that energy demand and the infrastructure, people are starting to put numbers to it, and they're saying, wow, an AI-powered system is going to be many kilowatts to use. And they were saying this about, and I got to give a shout out to Jim Murchie, runs EMLP. 3 years ago, he was talking about electric vehicles and the infrastructure you needed in the power grid to run electric vehicles. Well, now fast forward, everybody's like, wait a minute, we need a lot more infrastructure to run AI platforms, and people are not prepared for that, and they're not prepared for the capital expenditure either.
Well, I mean, you can have as many EVs as you want. If you don't have the infrastructure to make them run, I mean, there's only well, you won't go anywhere with them. Michael, let's turn back to employment for a moment here. Do you think perhaps we got the 50 basis points so that it was okay if a cut didn't happen the day after the election? Do you think there was some perception there? Or I feel like, more 50 basis point cuts through the end of the year seems a little bit.
Well, I think it's an open question still. We've seen actually some Fed members talk about they're open to it if the data demands it, essentially. It doesn't seem like the Fed's plan is to hold off on a rate cut. It seems like we're doing 50 now, but the plan is to switch to 25, and we'll do that as needed, essentially. And that gives them the time to see and really, recalibrate, as Chair Powell said. So have this kind of gradual sense of how the economy is moving, how it's reacting to these lower rates, because also the endpoint is unknown, right? The terminal rate, the neutral rate is estimated. And so that will help them figure out, okay, we're in the ballpark here, and fine-tune it more so than those 50 basis point cuts.
Well,
I'm sorry.
I said this the last time we were here, that from a historical standpoint, I still think the biggest Fed mistake was lowering rates to 0. They should have probably went to 2%. Now they've cranked them up dramatically. It's funny because we interview a lot of fixed income managers in our shop. Fixed income managers are loving this uninverted yield curve. They've got the wind at their back and are like, hey, terminal rates 3%. All the money's going to move out of money market funds into intermediate fixed income. And I'm like, whoa, wait a minute. Is the economy slowing or not slowing? And if you get one whiff of inflation, do you have the 10-year backing up a quick 50 basis points? And we've had this weird structure, inverted yield curve for so long.
Yeah, but nothing happened out of it, right?
Yeah, nothing
happened. So what if nothing? What happens with the uninverted?
But I've done the work on this, and we've had since 1985, I think 4 major instances of inverted yield curves. Each of them was followed by a recession. In each case, the recession only began after the yield curve normalized. And we're kind of at that point now. And again, this is one of these rules that's not a rule, because if it happens 4 times in 40 years, it's not necessarily a meaningful statistical situation. But that's been the pattern. So I think it's a little, yes, it's very typical and common to say, because this is why I looked at the numbers myself, because I'm like, oh, hey, the curve's normalizing. This is fabulous. That's not, how did nothing happen during this whole inversion process? Well, that's the downside, is because and I wish I'd brought this along and sent it. Was my graph where I have the inversions and then a red line where the NBER recession is started, and then when they declare it's over. Now, of course, you don't know that. How long does it take the NB?
A while.
Yeah. So you're only getting that number in hindsight. But when you put that in backward looking, that's actually the scary part of the inversion. It's not necessarily the inversion, it's the coming out of the inversion.
How much of that, though, is we didn't have forward guidance before, and now we have forward guidance? So the market was following what the Fed said was going to happen this time around, and the Fed did what it said it was going to do?
It did happen, though, in the blink of an eye in 2020. That's what happened too, though. Is the Fed, so the Fed, in a sense, that's good because it means the Fed's, sort of acting incredible. I would like it if they told us where the neutral rate is, because I know you could try to interpret it from the dot plot, whatever. My gut is somewhere closer to 3.5, 4. But I'm not the economist. You're the economist. I'll defer to you on that one. But that would clarify things so much because then your fixed income managers would know a lot more. I guess it's not up to the Fed to tell us too much. But I think that, to me, is really the most important question we can have is, what's the end game? Was the 50 basis points just Powell's way of saying, hey, I wanted to do this in July, and we didn't do it? But now, to your point, Chris, there's 7 or 8 rate cuts still priced in. 3 for the rest of the year at the next 2 meetings. Right. So the market gets ahead of the Fed. It would be nice to have some sort of grounding.
But the market's always ahead.
Always.
Right? I mean, look at last November, right? I
Yeah.
mean, you're pricing in, would they price in 8 cuts this year?
Yeah.
Right. And to Michael's point, everyone knows this. Data dependent. They say it all the time, and they continue to say it. So you've got 2 unemployment reports coming before the November meeting, a big election in between there, and multiple new claims, continuing claims data to go off of as well, plus ADP and everyone else. So they're going to have a plethora of data to comb through to come through the decision that it'll probably end up being exactly what they forecast. It'll probably be a quarter point, even though the market's pricing in 50 basis points.
But what I think is interesting is there's a statistic, and you can back me up on this, that from an unemployment standpoint, everybody's watching for a 10th here, unemployment rate changes. When unemployment rates change before a recession, it ain't a 10th, it's a couple of percent. It's almost like this Wile E. Coyote moment 1 month where, wow, unemployment is now really bad. And that's why, using a football analogy, we got a lead, we're going into the 4th quarter. Are the markets going to be able to keep that lead going? Because all of a sudden, October, November, you have some really bad unemployment numbers. Is it 25 or 50 or, something more? And that's what I'm worried about going into the 4th quarter, because our risk indicators are still pegged, at this point of time from the equity market standpoint. So you got this lead going into the 4th quarter. Are we going to be able to finish 2024 strong going into 2025?
Well, it's interesting because anecdotally, you two tend to have a more positive take on the markets. This is the first time I've heard, when you put the S&P data point that you'd pointed out and then the inversion of the curve and some of the things you're saying, this is the first time in 7 years since you've been on the show that, not that the narrative's changing, but it just, the data points are kind of coming together for you in a different way.
Yeah, and that's why when I said the return to normal, I mean, I've said this all year long.
But what is normal? What time frame are you referring to?
Exactly, and I've said this all along. The first time that the Fed, or when the Fed cuts, everybody's cheering that the Fed's going to cut. You may not want to see the reaction of when the Fed cuts. The other thing, return to normal, the VIX. The VIX has been unusually low, for last year and a half, 12 to 14. Return to normal, historical VIX, 18 to 25, 18 to 26. And our investors and traders able to withstand some volatility because it's coming.
Yeah. I mean, you and I have spoken about this before too. I mean, the moves that we saw on August 5th as an example, when we saw the rate cuts that just came out, market sold off, came back and hit, all-time highs the next day. These trends and these moves are happening. What could have taken a few weeks or a month or a few months are happening within sessions now.
People have become very conditioned to buy dips, and that's why. And the half-life of each dip seems to get shorter and shorter because people are more and more comfortable with buying the dip, to the point where in some cases the dip doesn't even last. I mean, look at the trading we've had each of the last few days where we actually had a little bit of selling in the morning, and then it's like clockwork. All right, we've had enough of a down day. Let's push it up into the close, and so. This is part of it. This is where I was saying earlier about the trading versus vis-a-vis the investment. The buying the dip, people have been conditioned to do it because essentially it's worked. Right. So if something works, people are going to keep doing it, And the problem is one day it doesn't because of something else, and it goes to your point, Chris, about like, why are they cutting rates? Are they cutting rate? Are we cutting rates to be? Is it a dose of vitamin C when the patient has the sniffles, or is this the start of a bigger course of medication? And I'll leave that to you, Michael, to
Well, I'll jump on and say what's going on right now. The everyman trade, I call it the everyman trade, is long in the tooth. The everyman trade is indexed by the VOO, by the dip. What's the other side of the everyman trade? GLD by gold. Gold's hitting new all-time highs. And so you hear these gold commercials on TV, you hear people on Twitter going, the way I'm going to become a millionaire is to buy the dip and index. That trade is very long in the tooth, and at one point when it unwinds, it's not going to be pleasant.
Hey, I'm a Jets fan. I know not to be I know to be superstitious going into a fourth quarter.
Are you a Mets fan also?
No, I mean,
I was going to say, we're going to have to kick you off the show.
That I'm a Yankee fan.
But you're not a Jets and Mets. Oh my gosh.
Jets,
And I've known you very, very long time.
And I keep my mouth shut.
But what, it's interesting, Michael, you brought up the point that the Fed isn't telegraphing what they think is good. Is it because they just don't know, or they're being cautious with their wording, or they don't want to get in front of an election? I mean, you could twist these headlines any way you want to fit a certain narrative.
Well, I think, they have the dot plot, right? So we have some path that really implies 2 more 25 basis point rate cuts this year. But they're leaving it open because, like you're saying, we got 2 more jobs reports before the next decision has to be made, and so things can change a lot in 2 jobs reports. Going into August, things look pretty good, and then all of a sudden we have 818,000 jobs revised away. We have 2 week to weekish jobs reports in a row, so things can change quickly, and then we get a 50 basis point rate cut, right? So I think it's leaving that door open to things can change. We think we're okay right now. The jobless claims data looks really good. The forward-looking stuff for that, the Warren Act, the Challenger layoffs notices, those all look pretty good. That we're not seeing layoffs in general. So that's a good sign for the labor market, but can we keep it up?
Anecdotally, anything you're hearing from clients, or is it along the same
More or less
process?
The same, yeah. I think, the hiring has been slowing down. People are pretty cautious, but the layoffs haven't been there.
Yeah.
So.
Chris, anything from our issuers? I know you follow the consumer space.
It's been quiet as well recently. Earnings came through, and we have a couple more coming up. We have Costco tomorrow. So you have a couple of big names that are still coming out. Consumer spend is still good. Look at the numbers, even though consumer confidence is waning a little bit, which is to be expected, especially on labor right now. But an interesting stat I saw and did a little research on it. Of the last 9 times that we saw a rate cut cycle begin, the S&P retail index has outperformed 7 of the 9 times against the S&P 500. So if that's the case, then you're looking at consumer spend coming to fruition a little bit more. It is 2/3 of GDP, but a lower interest rate on your credit card makes investors feel good, makes spenders feel good. They're going to go out and buy. And there's a have and a have-not. So there's potential there for this could be, if it is for the main reason that we see, which is inflation's back to where it was, the labor market's weakening, not broken, then I think people are going to go out there and spend. And I think we need to wait and see what the next couple of weeks bring. Q4 is coming up, right? Black Friday and Christmas.
Well, I also think too, once corporates get a better insight into what corporate tax rates are going to look like, how that's going to impact their capex, how it's going to impact fixed costs and hiring trends and so forth. Chris, we have 30 seconds to go here, but with your clients that you're advising, let's talk about older, perhaps retiring, nearing retirement. Anything that they are concerned about?
Healthcare is always on their forefront. Those costs have been going up year after year. We're getting a lot of questions like, how are we going to afford this? I mean, the good news is that the retail investor now has fixed income. And why is it called fixed income? It's because you invest in it and you get a fixed income. We now got fixed income of 4 or 5%. So they feel a little bit relieved from that standpoint that their portfolio can crank off at least 4 or 5% versus the ultra low interest rates. But again, they're worried about that inflation in the back of their mind. They see it on their healthcare costs. They still see it in the grocery store. So, I don't think the Fed can signal, hey, mission accomplished on inflation. If we get any hot numbers in January on inflation, which I'm worried about, price of oil starting to round up and come back up. But more importantly, like Boeing, they're going for they want a 40% pay increase, is what they're trying to negotiate. You get, a labor market starting to, slow down, but yet those people that are employed are still getting big raises. That trickles down in the inflation numbers there too.
All right, appreciate the intel as always, guys. Thanks for joining us on Trade Talks, and thanks for joining me for MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.